Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. A delegation of Taiwan's third largest fab company is in India to explore the possibility of setting up a manufacturing plant. It is said to be holding preliminary talks with Indian firms for a possible tie-up. This visit comes on the heels of Prime Minister Narendra Modi's call for making India a chip maker from a chip taker. So, today we ask if the government's latest push will turn India into a chip maker.
In December last year, the government approved a $10 billion package to give a fillip to semiconductor manufacturing in India. This incentive could mark the beginning of India's latest foray at grabbing a share of the $107 billion global foundry market, 64% of which is controlled by one tiny nation, Taiwan. So far, the scheme has attracted 3 players. They have already submitted proposals for setting up fab plants in India. The first is Vedanta, along with Taiwanese contract manufacturer Foxconn. The second is ISMC, a consortium led by India-based investment firm Next Orbit, which has entered into a tie-up with Tower Corporation Israel. And the third is Singapore-based IGSS, which has IMEC as a partner. The government, on its part, will provide 50% of the investment cost of setting up a fab plant. Their applications involve a projected investment of $13.6 billion. They have sought support from the centre to the tune of $5.6 billion. Tata and Vedanta have also shown interest in setting up semiconductor plants with foreign partnerships. But India's track record is not very encouraging. In 2005, bureaucratic hurdles ended up scuttling the plans of multinationals to set up fab plants in India. Attempts to attract chip makers in 2017 and 2020 also failed. In 2007, Intel moved to China and Vietnam after showing interest in India. In 2013, the government approved 2 proposals by JP Group and HSMC. It even promised to subsidize the project cost. However, the projects were aborted after failing to attract investors. So, when in September 2021, Israel-based chipmaker Tower Semiconductor threatened to pull the plug on its India plan over lack of policy clarity, it seemed like history was repeating itself. It had even called for Prime Minister Narendra Modi's intervention. The company is the technology partner of the Next Orbit Ventures-led consortium. But in May, ISMC announced that it had signed an agreement with the Karnataka government to invest $3 billion to set up India's first and largest semiconductor fab unit in partnership with the same Israeli firm, Tower Semiconductors. The current response from these players shows their confidence in the government's ability to provide adequate infrastructure and incentives. The government is definitely being seen as more welcoming of chip makers than before. All of this indicates that India's latest foray into the sector is not a false start and might bear fruit. Unlike in 2005 or 2013, the present situation in India is very different. India imports almost all of its chips. According to an analysis of data from the Commerce and Industry Ministry, India's semiconductor imports in 2021-22 increased 65.2% from 2019-20. The Ministry of Electronics and Information Technology estimates that India's semiconductor market will grow to $63 billion by 2026, from less than $20 billion in 2020. And with the 5G rollout underway, wireless communication will drive the country's semiconductor demand. So, the demand is expected to go up, adding to the economic rationale of a domestic chip-making industry. But will India become a global player in semiconductor chips? Well, it will be an uphill task with little guarantee of success since significant challenges remain. India's $10 billion incentive scheme falls short of competing schemes from countries with larger captive markets. India is not even in the list of top 10 in market share of chips. The US has announced an incentive package of $52 billion for chip manufacturing. China will be doling out $150 billion in incentives till 2025. So, India might not be able to attract the number of global chip makers needed to build critical mass.
First, the government package of 10 billion is a very small amount where this industry is concerned. You need massive scale. There are only about 10, maybe 15 companies maximum around the world which have been able to manufacture semiconductors at a scale where it is economical. You will need to most probably get one of those companies or several of them interested. You need fast clearances for environmental and other statutory clearances. You need a fast-tracked land acquisition process which has to be driven by the policymakers and by the government and maybe by the local state governments. You need very clear tax policy because that has caused a lot of heartbreak to companies getting into India. If you don't have those three, you will not be able to interest people who can do this. You need huge quantities of absolutely pure water and water recycling systems in any kind of chip manufacturing process. And that is a problem with India because we have endemic water shortages and we have very poor quality of water in most places. The few places where we have good quality of water, we don't have good land and road and rail connections.
Enriched with lessons from previous failures, the government should move ahead with greater resolve and readiness to make changes wherever necessary. However, it will face significant challenges, with the environmental impact of the chip-making industry being right at the top.
It is indeed a long haul before India starts producing and exporting advanced semiconductor chips. Let's now move on to another victim of supply chain disruption, the food. Even as the world looks towards India to raise the bar and fill the void created by the Russia-Ukraine war, a drop in paddy acreage is threatening to make the matter worse. Let's find out more.
Following Russia's invasion of Ukraine and amid challenges for global food supply, PM Narendra Modi declared that India was capable of feeding the world. However, instead of feeding the world, the government soon restricted wheat exports, citing a threat to food security. Now there are concerns about the outlook of rice production going forward. The area planted under the rice crop in the country is down this year. In the week ended August 18, paddy acreage in the country was down 8.25% over the same period last year. Paddy is the most important crop during the Kharif season, and over 80% of India's total rice production is done during this season. The lower paddy acreage is attributed to the erratic monsoon. Rice cultivation usually requires large amounts of water, and farmers in states without adequate irrigation facilities depend heavily on the monsoon. According to the IMD, rainfall is deficient in major rice-producing states. This is reflected in the shrinking paddy acreage in these states. It is down by almost 340,000 hectares in Bihar, 1.14 million hectares in Jharkhand, 630,000 hectares in West Bengal, and 270,000 hectares in Uttar Pradesh. While lower paddy acreage in some states remains a cause for concern, another threat to rice production in the country has emerged in the states of Haryana, Punjab, and parts of Uttarakhand. Many farmers in these states have reported a mysterious dwarfing disease afflicting their paddy crop. So far, agricultural scientists have not been able to identify this disease. It remains to be seen whether this will also affect the overall rice harvest in the country. In the previous season, India produced over 111 million tons of rice. According to a report by the US Department of Agriculture, India's rice production is estimated to decline by 0.9% to 128.5 million tons for the full 2022-23 crop year. This could be the first drop in rice output since 2015-16. For the 2021-22 crop year, India's rice production was at a record 130.2 million. So what are the implications of lower rice production in India? The decline in rice output could also hit exports and affect global supply dynamics. India is the largest exporter of rice and accounts for 40% of the global rice trade, supplying rice to over 100 countries. Lower rice production in India could have implications for food inflation in rice importing countries. Major customers are India's neighbors, including Bangladesh, China, Nepal, and some other Middle Eastern nations. India exported 21.2 million tons of rice in 2021-22, of which 3.94 million tons was the basmati variety.
Compared to last year, and any chances of improvement in acreage is bleak, as June and July is the peak sowing months for rice. So rice prices are already seeing an uptick at both wholesale and retail levels. This in effect is due to erratic monsoon this year. So we can't say that overall production will decline, but it will depend on other states' output as well. See, if there is decline in production levels and there is increase in prices, it will definitely have an impact on the global supply, as India is the largest exporter of rice in the world. So if prices in India remain high, the importing countries, many of which are very small and poor countries and solely dependent on Indian rice, they will feel the pinch.
According to the USDA report released earlier this month, India is projected to increase shipments, and the global rice trade in the calendar year 2023 is pegged at 54.7 million tons. Rice traders earlier hoped to cash in on the drop in rice crop yields and high production costs in Thailand and Vietnam. But the lag in paddy acreage in the country has been a letdown.
It can make up in Rabi. There is some improvement can be there, but overall the production will be less. We are a major exporter to the different countries. So it may affect, and global prices may also increase. So as a result of the shortfall in India's rice production. Last time because of the wheat stocks problem, so in Garib Kalyan Yojana and PDS, they shifted wheat to rice. So in some places the rice is given. So that also has reduced the stocks. So but now, in Indian point of view, still they can give it to PDS and all, but Garib Kalyan Yojana, they may not be able to extend given the stocks.
Besides the impact on exports, lower rice production also has implications for India's domestic market. However, unlike wheat, the central pool of rice stock is at 47 million tons as against a buffer norm of just over 13 million tons. This also includes the rice yet to be received from millers by the Food Corporation of India. Given the current scenario of wheat and paddy, it will also be interesting to see whether the government will extend the free food grain scheme beyond September 30. As the peak paddy sowing season is over, the outlook still looks bleak. If prices continue to soar, export restrictions cannot be ruled out. But experts say the curbs, if imposed, should not be drastic like outright bans and could be in the form of higher tariffs and minimum export prices.
From lush paddy fields, let's move on to the hustle and bustle of markets. The proposed NDTV's takeover by Adani Group marks Gautam Adani's second media bet in 2022 after the firm acquired Quintillion Business Media Limited in May this year. While the acquisition seems to be hostile, analysts believe it is the retail investors that stand to win. Here's a report. Putting an end to months of speculations, billionaire Gautam Adani's media division officially sought control of New Delhi Television or NDTV on Tuesday. Adani Group said it had used financial rights to purchase a 29.18% stake in NDTV through the conversion of loans into an equity stake in the promoter group. It further laid out plans for a subsequent open offer for a stake of another 26% at 294 rupees per share, valued at 493 crore rupees. On its part, NDTV said its founder promoters had not consented to the exercise of rights. Analysts said prima facie the takeover appears to be a hostile one, and that the battle of ownership could be a long-drawn affair. Thus, they believe the camp that stands to gain the most is that of retail investors. According to A.K. Prabhakar of IDBI Capital, in NDTV's case, the retail shareholders stand to gain if the stock price continues to move up. Those who bought the stock at a much lower rate will be better off selling them in the secondary market rather than tendering them via the open offer. On the bourses, shares of NDTV hit the 5% upper circuit on Wednesday, hitting a 14-year high of 384.50 rupees on the BSE. In the past 3 months, the stock has zoomed nearly 140% as compared to 8% rise in the S&P BSE Sensex. Moreover, over the past 1 year, it has soared 382% as against 6% gain in the benchmark index. That said, independent market analyst Ambrish Baliga says there is a surprise element in the entire development.
There has been a murmur for a while. So the announcement was not a major surprise, but what surprised me was the structure of the deal. I mean, how could Adani's get Vishwapradhan Commercial Private Limited, VCPL, so cheap at 114 crores, whereas the value of the warrants was worth close to about 800 crores? Secondly, the open offer at 294 is about 20% lower than the last closing rate. So generally, public shareholders would not tender their shares at a discount. However, there is one large shareholder, a fund holding close to about 9.75% stake in NDTV. So one needs to see as to how they react to this open offer, and that could in fact tilt the balance. Meanwhile, we've seen the NDTV promoters have indicated that they would challenge the hostile bid. So it could be a long-run affair. Hopefully, the public shareholders should benefit from this warfare.
As per technical charts, NDTV shares can move up another 15% upside and may hit 450 rupees mark in the near term. On Thursday, the monthly FNO expiry for August series will drive the markets. Besides, crude oil prices and investors' anticipation of Fed Chair Jerome Powell's address at Jackson Hole will be eyed. The remarks made by NDTV's promoters suggest the takeover was against their wishes. Some are even calling it a hostile takeover. Our next report explains what hostile takeover is.
On Tuesday, Gautam Adani-led Adani Group announced that it has acquired a 29% stake in NDTV and will soon launch an open offer to acquire another 26%. NDTV's owners have stated that it was done without their consent. While some call this acquisition an example of a hostile takeover, others disagree. Let us discuss what a hostile takeover is. A hostile takeover happens when a company or acquirer sets its eyes on another company or target and goes on to acquire it without the agreement of the board of directors of the target company. There are generally two ways in which a hostile takeover takes place. In the first one, the acquirer makes an offer to the target company's shareholders to bypass the management to get the required stake. This is called a tender offer. In the other, an acquirer may start a proxy fight to replace the target company's management. But why does a company initiate a hostile takeover? The reasons for a company to take over another company may be diverse. One reason may be that the acquirer considers the target company as undervalued and hopes to benefit from it in the long run. Another reason is that the acquirer wants to enter the sector in which the target company operates. Let us now look at some examples of a hostile takeover in the past. In 2010, Kraft Foods acquired the famous British brand Cadbury through a hostile takeover. In September 2009, the CEO of Kraft Foods, Irene Rosenfeld, announced her intentions to acquire Cadbury. It offered $16.3 billion for the deal. However, Cadbury's chair, Roger Carr, rejected the offer. Carr appointed a hostile takeover defense team. The UK government also opposed the offer and said the British company must get its due respect. In 2010, Kraft offered $19.6 billion for the deal, and Cadbury finally relented. In March 2010, the takeover was finalized. In another attempt in 1993, textile tycoon Nusli Wadia took over Britannia as its chairman after a hostile takeover from Rajan Pillai. Pillai had held the stake in Britannia through Danone. Wadia made Danone switch sides and in total held a 38% stake in the company, taking over the control from Pillai. India Cement's acquisition of Rasi Cements in 1998, Imami's acquisition of Zandu in 2008, and L&T's acquisition of Mindtree Limited via Cafe Coffee Day are some other examples. Can the target company prevent a hostile takeover? Yes, the target company's management may employ certain strategies to stop the takeover. These include the golden parachute, the Pac-Man defense, the crown jewel defense, and the poison pill. In April 2022, Twitter initiated the poison pill strategy to prevent the hostile takeover of the company by Elon Musk. Under the strategy, the management puts a cap on the number of shares a person can buy. Then, additional shares are distributed among the shareholders, except the acquirer at a discounted rate. This dilutes the holdings of the new, hostile investor. It makes it difficult for the acquirer to go forward with the plan.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The stock of NDTV meanwhile climbed 5% to hit upper circuit limit as well as its 52-week high on Wednesday. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.